Just on Monday, April 21st, 2014, we had a pretty slow day in the market as far as the ebb and flow of the price action was concerned. That could easily be a function of the long 3-day holiday weekend that we just saw. But at any rate, when you step back and you reassess the broad market structure, the way in which it's constructed with the major averages and the leaders and what have you, the prospective and actual capital sector rotations. Not much has changed. Just for the sake of brevity and clarity, let's whip through it. The S&P 500 index daily time frame looks like another V-shaped rally, not far from recent all-time highs. Still rising and properly aligned longer-term moving averages. It's hard to argue that there's been any kind of meaningful technical damage sustained. As far as the S&P is concerned, the lingering issues for me: no 200-day moving average test by price, yellow line here, and no 10% even for a bull market garden variety correction, both since the year 2012. Still an abnormally long time to go. So you don't want to just be assuming that we have just another fresh, healthy, sustained leg higher coming. Again, that doesn't make it an easy short given the V-shape we saw since last week, but I tend to look at this chart as being a bit sloppy, and I tend to look at the upside as not necessarily barring some kind of real, just grand finale blow off top, is not particularly enticing. Dow Jones Industrial Average has those stodgy mega cap firms. Looks to be another beneficiary of capital inflows of late, away from the obvious growth leaders in the tape. This could be a double top in the Dow, but again, that's pure conjecture, theoretical. It would need to get below at least 16,000, if not below the midwinter lows for that to happen. So for now, the Dow and the S&P remain resilient. The real issue we run into is when we look at the NASDAQ. Look at all the buying power used up over the past couple of days, and relatively speaking, compared to the S&P and Dow, not much has been accomplished. Still a pattern of lower highs and lower lows on the NASDAQ composite. Of course, housing those institutionally sponsored, high growth, liquid marquee issues. Netflix reports after the bell today. Again, we're in earnings season. I think you have Facebook, Amazon, the whole gang coming up. So you have to be aware of that. But still, NASDAQ, lower highs, lower lows the whole way down. No real discernible evidence that we put in the kind of a major correction low. The weekly chart for the NASDAQ, I think for me the most important thing is that we now have a broken multi-year rising channel, steep one at that, dating back to November 2012. Similar comments apply to the Russell 2000 index. So even though the S&P and Dow look within a stone's throw of recent all-time highs, the Russell and the NASDAQ, not so much. They still have a lot of work to do, and there's already been a bunch of buying power used up over the past couple of days. Again, if this is 2013, consider everything I said just to be null and void, but I'm not going to be operating under that, or at least I'm not going to assume that playbook is necessarily intact. So that's pretty much the structure of the market. Biotech's a great day today, all things considered, but the volume was not overly impressive, and once again, vis-a-vis the damage done, again, when you look at this chart as a whole and vis-a-vis the S&P and Dow, not much has been recouped yet in terms of the losses since late February. Biotechs, of all the leading parts of the market, I believe, were the first to top out this winter. So again, let's not assume that the correction is over just because you walk in and have a spirited day with the biotech today. There's still a lot to prove. The initial trade off us, frankly, not falling into the abyss right away, us not crashing into the abyss with this dramatic reversal last week. Yeah, we got that initial bounce, and now it pretty much comes the hard part. It's I think there are a lot of moving parts and moving pieces to the market. We'll see how these earnings are digested by the market, but you definitely have names like Kellogg and a bunch of these stodgy mega caps that are clearly outperforming, that have clearly been this kind of bastion, this safe harbor, even while the leaders get sold. So it's not necessarily the healthiest sign. I mean, I know energy, you can see it's kind of running away from all of us. I have given you plenty of these names, my blogs and our site of 126 Run Trading Service, FANG, CPE, all these energy stocks, and that's all fine and great. I hope some of you caught them. But you don't want to discount the fact that energy is a very late cycle mover in a bull market historically, as are the utilities, as are the consumer staples, which have all been benefiting from these capital rotations. And typically, again, that happens oftentimes at a top. It doesn't really happen, let's say, in the early or a healthy part of a trend. Just something to keep in mind, especially when the growth names get hit. Now, what would help the bull case if, names like Facebook, if they can recoup? Good day today for Facebook, earnings later in the week, but still, let's say Facebook has a real great bull rally after earnings, you could still move up to 64, 65, maybe even 66, and it would still be below this kind of mini topping pattern going back a couple of weeks or months here. So just a little perspective here. You got to keep that in mind. Amazon, similar comments apply. It could rally up into the 340s and still have a lot of issues technically. Declining 50-day moving average. Google, I believe earnings out of the way. Watch it below 525. Still has the look and feel of a descending triangle pattern. Has the look of distribution. So again, don't get lulled into complacency even with the recent snapback in the market. Two names which do, on a more positive note, have been acting well, and I've been highlighting these for you in these recaps on the weekly charts. Zillow and Tesla. I still think, and I know Tesla has earnings coming up. Zillow check earnings, but basically, I still think these two, if we do see an immediate resumption of a healthy, broad-based bull trend in the market, I probably would be inclined to look at these two as the leaders, Tesla and Zillow, above all else. Again, Netflix after the bell today. Now, a couple areas of concern beyond the leaders. The financials, JP Morgan, textbook bear flag below all moving averages. Bank of America, bear flag. Citigroup here with the financials. Goldman still trying to stabilize. Morgan Stanley just sloppy, even though it's been resilient. Wells Fargo feels like it's trying to be. It feels like it's churning up here, as resilient as it's been. Berkshire Hathaway been a monster, but still tend to think upside for the financials, in my view, is likely limited. If you are short, I definitely trade against a 20 or 50-day moving average just above. It's a well-defined trade. Even if you disagree with it, you can still get out. Let's say if you do take the short trade there. Again, the credit card plays, Visa, I think they have earnings coming up. We caught the initial breakdown. It checked back to it. Check earnings, but I'm looking for a reason to get back involved there. American Express still looks like a bear flag. MasterCard, again, still looks pretty sloppy here. Again, check earnings for all of these guys. GM, I think, has earnings. We caught the initial breakdown. It's at a 126 trading service. Check back to the breakdown point. I'm still looking for a reason to get back involved with GM because I still believe it's topped out technically. I think GM is probably going to go below 30 now into the 20s based on the technicals. Even some strong names of late, like the steel, starting to weaken a bit here. So again, you don't want to just be assuming the correction is over. Semis resilient, but again, names like Intel, they're just kind of levitating up here. So just be careful chasing them. I still think if we do see another leg down, the semis could easily be setting up as a nice short here in the next couple of days, even week or two. Again, the transports, again, get these holdouts. They've had a terrific run, and they're still being resilient. We caught the initial short in Union Pacific. This is the monthly chart, though, for Union Pacific, and you can see we covered before earnings, luckily got out of the way. But this monthly candle has the look and feel and all the hallmarks of potentially, depending where it ends, being a hanging man. It's had a very steep run, has Union Pacific, so I would not be inclined, just using this as the poster child, to chase the transports up here. I do think upside is limited as far as the trannies are concerned. So again, that's pretty much what I'm seeing as far as equities. We know the structure. Intermarket analysis, TLT. Bonds, I got short them Friday. Bearish engulfing candle, and they tried to go green. They were green for most of the day, and then they flipped red, so far so good there. Monthly chart still a head and shoulders top. This recent spirited bear market rally, which flipped, seems like a lot of guys into kind of sexy contrarian bulls on bonds. I still think it's a bear market rally. I think it's a bearish rising wedge, and I think it's ripe to break over. We'll see. Once again, I'm taking another shot here. Got stopped out a couple times quickly, but overall, I mean, this topping pattern in TLT was something I was talking about in my weekly strategy sessions dating back to 2012. So we've been on the case for a while. This is still a confirmed topping pattern. So these things take time to play out, and you got to show patience and you got to show discipline. That's pretty much the way I look at it here. I'm looking for more follow through, pretty much. Again, as far as treasuries are concerned. Now, gold miners. I've been flat on them for a while. A lot of gold bears been excited about the price action of late. First and foremost, GLD is still above a confirmed head and shoulders bottom, so you can't get too bearish yet until GLD cracks below 122.50. Silver, of course, has been just horrific. I mean, there's no way to sugarcoat it. Silver has been arguably, the real weak sister in the group, and arguably kind of the real drag on the entire precious metals and miners sector. So again, you're going to have, if you want to be a bull here, for more than a quick flip, a quick trade, you got to see silver stabilize, in my opinion. It doesn't have to rocket ship, but it does have to at least stop going down. That's really the first step. Now, gold miners, GDX, again, remember, these things got to their lower Bollinger Band today. They did not, I laid out the levels for you last week in a blog post. They did not lose 23 on the GDX, and especially did not lose 22.20. And you can see the closer we got to 23.04 and then a reversed higher at the lower Bollinger Band. And the bands are compressed, they're pinched in. So a big directional move is likely. Maybe this is the false move before the real move. We'll see one at a time. But the juniors flipped green by the end of the day. So this is the GDXJ, the straight up. The triple lever one, JNUG, finished up 2.34%. And this is in a day when it looked like we had absolute carnage in the whole space. And you have JNUG finishing up almost 2.4% with a hammer candle. So again, maybe this was kind of a bear trap today. Again, too early to tell. I'm not trying to be overly biased here. I'm just trying to call it like I see it. But there was an awful lot of excitement in the gold bear camp this morning. And again, when you see these kinds of move and then the upside reversals, you don't want to be discounting. Maybe it's a bear trap. Keep an open mind. That's pretty much all I'm trying to say here. Whichever way you come out, I don't want to hear the fundamental arguments. Just keep an open mind to the fact this might have been some kind of trap. Because, again, we've been talking about this on GDX. Bullish divergences going back to last spring. We traded them. Each time we got these rallies, we've had good luck inside our 126 trading service for the most part in trading these rallies going back a year now. And this still could be a big bottoming pattern in play. But, regardless of what I say in these videos, these, the bulls in this space, they simply must arrive right here, right now to kind of take the baton. If not, then, I guess the gold bears will be, correctly vocal again, especially if GDX loses 23 and then 22.20. There's still your downside levels to observe there. Crude oil, kind of drifting up to this weekly chart consolidation. We'll see how it negotiates. Probably needs to clear 38. Natty gas, pause today. It's got to get back above 26.20 and especially 20 and then 26.50 levels upside that I'm watching there. The softs, coffee, a whole lot of nothing today, but overall still pretty impressive. Sugar trying to find stability down here. So, look, overall, the market, we still have the same structure in place. S&P looks like another 2013 V-shape, but when we get over to the leaders, again, earnings season's probably going to be so critical. Still, the NASDAQ, impressive on its face. It looks like it's covered a lot of ground, and it has since last week. But it's really a drop in the bucket compared to the damage sustained vis-a-vis the highs earlier this year. Similar comments applied to the Russell and the biotech. So again, if you want to take your shots, there's definitely some actionable opportunities out there. It would seem, but again, energy and some of these names, they are late cycle movers. So let's see pretty much how we progress the rest of the week. Even names like Plug, you could see a corrective overall market, a slow, sluggish market. It really does put a hamper even on the sexiest looking setups, and this was a narrowing consolidation. A lot of eyeballs were on it, and then look what happened. Got an opening pop, and then they faded it. So again, don't get lulled into complacency that this is 2013. Still a bit more to prove before that happens, and we still have our late cycle names like your Kellogg's and your Staples and your utilities and your energies. You still have them kind of leading here, even though we have the semis and the transports resilient overall. The structure of the market, it's not healthy just yet. Again, let's stay a bit defensive. Hope you enjoyed the video. Have a great evening.